Looking to finance your franchise, today we'll explore the 7 most common methods entrepreneurs use to fund their franchise purchase. Now, this could be a new franchise, you could be buying an existing franchise or franchise resale. But before we delve into the specifics, remember to click that subscribe button and enable the notification bell, guaranteeing that you stay in the loop with all our valuable updates, especially as we come up with more financing mechanisms for you prospective franchisees and current franchisees out there. Now let's dive into it. Number 1, my favorite choice, an SBA Backed Loan. This method involves obtaining a loan from the Small Business Administration, also known as SBA, government agency that supports small businesses throughout the United States. The SBA is familiar with various franchise changes and considers this knowledge when evaluating loan applications. There are hundreds of banks that are regularly issuing SBA loans, particularly for franchise groups, making it easier to find the best loan options with competitive rates and terms. The advantage of an SBA-backed loan is that the banks are more willing to lend, knowing that the SBA will share in some of the risk if the borrower defaults. Generally, the SBA is going to back 75% or 85% of the loan value. You could also find partners or investors partnering with others or seeking investors as a way to pool financial resources and expertise to buy the franchise. You can get some smart money, so people writing a check, but also have industry experience or at least functional experience that can help you as you run your enterprise. Investors with relevant risk can reduce the chances of failure. Many investors are interested in supporting your potential franchise, a proven franchise concept, I would hope, without actively participating in its operations. However, sharing profits with partners or investors is a trade-off for reducing personal financial risk. Number 3, you can get an equipment loan. So some franchises require expensive equipment to operate, such as specialized machinery, vehicles. Think about restaurant equipment. We've covered fitness franchises. An equipment loan is specifically designed to finance the purchase of necessary equipment for your business. These loans are secured by the purchase equipment itself, which serves as collateral for the loan. So while this option can get the business up and running quickly, failure to make loan payments can lead to repossession of the equipment, i.e. you can't be running your business anymore. Number 4, in certain cases, there's franchisor financing. Franchise brands partner with lenders, offer financing options to the potential franchisees. The relationship between the franchisor and lender may result in more favorable loan terms and a quicker approval process. Franchisor financing can be a convenient option for franchisees, as the franchisor knows the business model and may be more willing to assist with the financing. Number 5, you got personal loans. When other funding options are unavailable, you might want to seek a personal loan to buy a franchise. You can look at unsecured loans, meaning there's no collateral, but the interest rates are really high. Borrowers must have a good credit to qualify for halfway decent terms, and defaulting on a personal loan can have serious consequences for your credit score and future borrowing abilities, whether that be a mortgage for a home or a car loan. Number 6, 401k rollover. This method involves using funds from your 401k retirement account to invest in the franchise. The process, known as rollover as business startups, ROBS for short, involves creating a new 401k plan for the franchise. The funds from the old 401k plan are then transferred into the new business's 401k and borrowed back to finance the franchise launch. While it allows access to the retirement funds, the IRS closely scrutinizes this approach, and entrepreneurs should seek expert advice to ensure compliance. And then finally, number 7, tap the Heloc. Homeowners will build up equity in their homes, can use a home equity line of credit, short for Heloc, to finance the franchise purchase. A Heloc allows borrowers to borrow against equity in their homes, typically at lower interest rates than a personal loan or even SBA loans right now in 2023. However, using Helocs put the home at risk, as failures to make payment could lead to a foreclosure on your house. So why not just pay cash if you have the money? While paying cash for a franchise seems financially secure, it ties up all the funds in the business. Many entrepreneurs choose to finance the purchase to diversify their investments and retain cash for other opportunities. Finance allows for greater flexibility and options, even though it involves some level of risk depending on the chosen method. There you have it. 7 of the most common ways to finance your franchise purchase, whether you decide an SBA-backed loan, seeking partners, tapping into retirement funds. Each option is going to come with its unique advantages and disadvantages, risk, downside risk. Remember to weigh your choices carefully and seek professional guidance to make the best financial decisions for your franchise journey. If you found this information helpful, don't forget to like, subscribe, and share this video. I'm Patrick Findaro from Vetted Biz, and I'll see you in the next one.